created with free version for non-commercial use.
Hello guys and girls, welcome to episode 3 in the Foundation series. So this is the monster episode. Now we've actually broken this down into 3 parts. So part 1, part 2, part 3. This is going to build on the entire Falcon strategy. It's very, very important at this stage that you go through this as much as possible. And as we break down each core principle, each one builds on each other and you'll understand fully how we look at the markets. Very, very excited for you to take notes, sit back, absorb the information and make sure that you really take it serious, because these are the core principles that is going to set you up for success, to understand all of the mechanics from how we enter, how we manage, our psychology behind it. You're going to absolutely love it, and I'll see you in part 1. Right guys and girls, let's get into episode 3. So as I've said, we've broken this down into 3 parts and each part builds on each other. So let's start off with the very first, with nature theory. So nature theory is so important when understanding how the market moves. The market moves in phases. We have impulse, correction, impulse, correction. This is how the market is moving. Identifying these phases will be programmed into your subconscious with enough practice, and eventually spotting these setups will become second nature to you. An impulse is the phase in which price is moving in one direction with higher momentum than usual. An impulse can be identified on all time frames. No market moves consistently in impulses or in one direction. There will always be corrections, since the market moves in cycles. The market needs to breathe, it needs to pause, and this is the kind of patterns that we'll see in these corrections. These signify opportunities for us to enter the market at an area of value, as long as the rest of the strategy criteria has been met in order to enter the trade. Corrections are counter trend movements that consolidate. The candlesticks will be noticeably smaller with no real progression in either direction, which I outlined in Raisin trend lines. So these corrections can be very, very powerful and give us an indication as to what is going to happen next. Now what I want to do is take you through the first chart work with nature, how to spot it, so then you can practice for yourself. Let's get into some chart work now. Right guys and girls, let's take a look at the first key concept of the Falcon strategy. So we're going to start off with the nature of the market. So what is the nature of the market and why is it important? Well, the nature of the market is the way that price moves. And the reason why it's important is because it gives us a good indication as to what is likely to happen next. So here we have the Great British Pound over the Canadian dollar. What I really want to establish here is first trend. So if we take our trend line tool, it wouldn't be unreasonable to assume that this would have been the trend, right? So if we take price back to this area here, we've moved off, we have our upward sloping trend line. You can see we've moved off here, and you can see our pattern here. You're going to learn more and more about the patterns in the episode, but as you can see here, as we're moving to the upside, what nature do we have? We have our impulsive nature, and then we have our corrective nature. So what clue does the corrective nature give us? Well, if we were to break through the trend line, what would that mean? Would that mean a change in trend? Well, the nature of the market helps us, because if it's corrective, it means there's been no progression, and then we are actually anticipating this to move to the upside. That is the key difference. So what happens here? Well, let's play this forward. We start to correct, and how do we break? Well, we're breaking correctively, and we're just moving sideways. So at this point, how have we actually broken the trend line? If we broke impulsively, if we had impulsive nature, would it be expecting a trend change and a move to the downside? But because we broke correctively, there's been no progression within the market. So we're actually expecting this to break to the upside. So as we play this even further, so can you see how we're not surprised that this broke to the upside? But if you was only relying on a trend line and you thought that the trend line was absolute, you'd be constantly getting caught out. So as we can evolve this, and again, you're going to learn more about evolving your trend lines in this episode, but overall you can see how the nature of the market was the most important thing. And then what starts to happen, we move up, and then now we're correcting, we're moving down, and then we're moving off. So now we've established some trend. And if you look here, we had our corrective price action here, counter to the trend. So we have our move up, our correction, corrective nature. So it's the nature of the market. It gives us a clue as to what is happening next. So when you can understand what is the nature of the market telling me, that keeps you ahead of the market. Right, so now we understand the nature of the market. As you can see, it's so important to ask yourself those great questions of how did it break the trend line? How is price moving, rather than seeing price for what it is? The market has a certain type of nature. When you can understand that, it's very, very powerful. Building on that, we move on to structure. So what is structure and why is it important? Well, essentially, the basis of nature theory is to understand that no matter what price is doing at any given moment, what is forming, where it is, we can outline what phase a chart or pair is currently in. Rather than relying on indicators or putting heavy significance into levels that can easily be broken, we put extra effort into understanding the entirety of the chart and keeping it as simple as possible. As a beginner, you will see just how simple we keep it with our charts, with very few tools to analyze price action. As a trader with experience reading this course, it may be a little bit different to what you're used to, but very quickly you will realize how much more profitable this way of trading truly is, increasing your returns and allowing you to fully capitalize on positions in all market conditions. And that's the most important thing. If you've already been a trader for a while, then there may be a few things you have to unlearn, but that's totally okay. You'll see how much clearer the market really is. Now let's take a look on structure and how we build that structure with some chart work. Right guys, so now you understand the nature of the market. It's important that we build on this. Now we're going to take a look at structure. So what is structure? Well, essentially structure is just giving you the overall view of the market direction. But what we do have is outer structures and inner structures. Let's take a look at the outer structure first. So what is that? Well, if we look at pound dollar on the weekly chart here, we take simple trend and we're identifying our outer structure. So as we do this, we're just simple trend lines, and then we're looking at the overall bigger picture. Now you can see we have our outer structure. Really simple, right? Now within this just gives us an overall bigger picture of what is happening within the market, the overall direction. But the most relevant bit of price will be our inner structures. This gives us more of an indication of what's literally going to happen over the coming weeks and over the coming months. And you're going to see that within these structures, we have prices like so that gives us forms of patterns. These are our inner structures. Even within this big pattern here, you can see there'll be many different patterns within it that we identified. This is our inner structures. And you're going to see this as we zoom into the lower time frames, but it's firstly important to understand, right, what is the bigger picture? What is the outer structure? You get that done first, and then we work our way down and we look at our inner structures. That's when we zoom in, we go to the lower time frame. So we work our way down to things like the daily chart. Then we can see, right, inner structure. If we take a look at this particular bit of price, as you can see, we were trending to the upside. We was moving up, pulling back, moving up. Now, if we just put on simple inner structure here, as you can see within there, we make up various patterns. So even within this structure, like so, there'll be different bits of patterns. So for example, this will be a pattern. You're going to learn more and more as the episodes go on, what these patterns mean, how they behave. But as you can see, even just simply drawing them on, this will be a pattern, this will be a pattern. And then especially within here, this will be a pattern that we look at. So by understanding, right, what is the outer structure showing me? And then we work our way down to the inner structures. And even with them, there'll be smaller patterns that then we can utilize, right, what's going to happen next. This is exactly how we anticipated selling this from here to move to the downside. So once you understand your outer structure, it keeps it very, very simple for you to focus on the inner structure. That shows you the most recent bit of price action for you to focus on. Some of you previously, you may have even done things where you've had trend lines coming from, years and years ago, and you think that's the most relevant bit of price. What we found is once you can build your outer structures and then focus on your inner structures, you'll then realize, right, what is the most relevant bit of price action for me? that will give you the highest amount of accuracy. What I want you to do is simply start building these outer structures on multiple pairs so you can see them, then work your way down and find your inner structures. And as the episodes go on, and throughout this episode, you're going to learn how to build on this. And we're going to be focusing on impulses and corrections within these structures here in the next section. Right, guys and girls, as you can see how the structure and the nature, they combine together nicely. This moves us swiftly on to the next part, which is impulse and correction. One of our favorites. Remember, this is how the market is moving. So impulse and correction. Now, what we have are 1, 2, 3 structures. 1, 2, 3 structures are essentially a series of impulse and corrections. So you have impulse, correction, etc., etc. After a reversal pattern, a change in trend is confirmed, the first impulse wave in the other direction would be considered number 1. The corrective phase after this would be considered number 2. And then the next impulsive phase, that would be considered number 3. So as you can see, 1, 2, 3 wave structures. The amount of impulse and corrections that can occur does not have to be 3. This is just an outline as to what to look for to cement that idea in that price moves in these phases. Now you're going to see this on the higher time frame, on the lower time frame, and really get an understanding of the bigger picture. Now I understand that this may sound a little confusing at first, especially if you're completely new to Forex. So let's take a quick look at an example of what this looks like visually on the charts, because it is really simple and you're going to see how the market really moves. Let's take a look. So building off of structure, it's important for us to understand the next phase, which is impulse and corrections. So essentially, what are impulses and corrections? They make up the market. This is how price moves. The price is moving either impulsively or correctively, and they make up various patterns and structures. Well, let's take a look at pound dollar. So what do we have here with this bit of price? Well, we have an impulse, a correction, impulse. This actually makes up a pattern as well, makes up our ascending channel. So you have on all time frames impulses and corrections. They give us an indication of what's going to happen next. So if we look at this bit of price here, what can we see? We have our impulsive leg, our corrective leg. Now notice how we're anticipating this as an impulsive leg up, but what happens? It kind of moves up correctively. You see it's more lower momentum. It's not solid momentum like this. So you see it moving up correctively. Why is this important? Well, we're expecting the impulsive leg, but as this moves up correctively, this gives us a good indication that potentially we're going to have a reversal. So it keeps us ahead of the market. So understanding the nature, what's the nature giving us? Well, it's corrective nature. So you see how it all builds together and shows us that, right, yes, there's an impulse. Here's the correction. Here's the impulsive leg. But the impulsive leg doesn't have to always be large momentum candles. It can move up be moving up slowly, but it is showing us this is moving up correctively, which gives us an indication that there's a reversal on hand. And then what do we have next? So after we break this ascending channel, we have our impulse down. There's a correction. So you can now see why this is moving to the downside. By us identifying, right, that's the correction, what's going to happen next? The impulse is a natural progression within the market. So we get the big drop, which is of course the 2008 crash. Then what happens next? Well, what happens next, we actually get a huge correction for quite a few years here. You can identify this is one big correction. So essentially, you have a big correction here, but within that, we have impulse, correction, impulsive leg. But this moves up correctively to give us an indication that this is ready to sell off. Then we get a huge impulse, a very obvious one because it's just big, large momentum candles. Then we get a big, long correction. Then it's our next impulsive leg. This is the important part. As you can see, through this correction, there's going to be many impulses and corrections, which is the matrix of this, on the lower time frames. As we zoom in, there's going to be many tiny little impulses and corrections, but they make up one big correction. So it's more so zooming out and taking a look at the bigger picture and clearly seeing, here's the impulsive leg, here's the corrective leg, here's the impulsive leg. Now this is going to make a bit more sense when we look at this part, because this part's not so obvious. Now, if you look at this section, you can see it's just heavy momentum, heavy momentum. It's very obvious that that's the impulsive phase and the impulsive leg. This is the corrective part. It's this part here. Let's go to the daily. So as we zoom in, I'm sure we can all agree that this is the impulsive leg to the downside. We're trending to the downside. But what is more obvious on here? Well, what do we have? We have our corrective part, which is very similar to what I showed you previously. And then we sold off from here. But we sold off in the form of an impulse. Then what do we get? We get a correction. What happens next? We get an impulse. then we get a correction, then we get an impulse, then we get a correction, followed by an impulse. So if we zoom out again, you can see on the higher time frame, looking at it, it's just one big impulse, correction, impulse. But within this leg, which is not so obvious compared to just that momentum, and you may not have predicted that to be that impulsively with the overall crash, you can see here there's structure here. And as we work our way down and we go to the 4 hour, the patterns become clearer and clearer when we look at these legs. So by understanding what phase we're in, it gives us a very good indication what's going to happen next. Then we can look in more detail within here. Right, so what is the pattern showing me? What is going on? Is it a continuation pattern? Is it a reversal pattern? Then we know what's going to happen next with a lot more probability, and that gives us an edge within the market. So then when we're looking at price like this was how we was able to anticipate the big sell-off here, because this was just one big correction. So you can see why now, and when you go back to our older webinars, why we was looking for a sell here to come towards the low of this correction, which is where we are now. As you can see, we got our original impulses, and then what happens? We got a big correction. So we got an impulse, a correction, and an impulse. So within it, there's always impulses and corrections, and they go right to the lower time frames, to the daily, to the 4 hour, to the 1 hour, all the way down. But it's important, once you can look at the bigger picture and say, right, I can actually see what phase I'm in now, it gives you so much more indication of what's going to happen next. Right there, you can see very corrective, all the way to the double top formation, and then we're looking for the next impulsive leg. So you know you're looking for the next impulsive leg because you can see we've had impulse, correction. What's the natural progression of the market? To then move to the downside. So if you have, let's say for example, an impulse up, you have a correction, what are we expecting next? We're expecting a move to the upside. We're expecting natural progression to continue in the direction of the overall trend. But sometimes it's just huge momentum like this, and sometimes you have lots of opportunity to get in. Impulse correction, impulse correction, impulse correction. See what I mean? One impulsive leg, but many opportunities for us to take advantage of these sell setups. This gives us so much more of an edge in the market, and you can capitalize on so many positions. But of course, once you know what phase you're in, whether it's the impulsive phase or the corrective phase, we can then look at that in a bit more detail, look at the patterns, right? Is it a selling opportunity, a buying opportunity? Because even within these phases, you can still buy and sell within them. You can take short-term positions, medium-term positions, but the longer-term move, it's important for you to see the phase so you know the overall direction. So that is impulse and corrections. That's literally just how the market works. That's not the strategy part of it. That's for you to just understand that's how it's working. Now we're going to be moving on to the other concepts that just builds on understanding the entire strategy. As you can see, guys and girls, impulse corrections, once you see it, you cannot unsee it. This is just how the market has been moving for years and years and years. But once you're too cluttered and you're too zoomed in, you can't see that. So now you can see that the market is moving impulsively or correctively. And it's up to us as traders to understand, are we in an impulse? Are we in a correction? That gives us a much bigger indication of what's going to happen next. But once we understand those basics, now we need to go into multi-time frame analysis. This is where we build everything from looking at everything combined. So what is multi-time frame analysis? Well, essentially, top-down analysis is the procedure of first analyzing price on the weekly and then working your way down through all the time frames towards the entry. So you're starting on the higher time frames, drilling down to the lower time frame to combine that picture of where we expect price to move. By doing this every time on the charts, we can ensure that we're not forgetting the bigger picture and we're not getting caught up into the intraday kind of lower time frames being too zoomed into the market. We've got the bigger picture at hand. And again, this is a process that you'll get used to. This is a bad habit that can really cause you to lose positions when you're too zoomed in. When you're looking at the lower time frame too much and you're too far zoomed in, you tend to forget what the bigger picture looks like. So we want to avoid that bad habit. But as I mentioned previously about reversals and continuations, top-down analysis is an important factor when you're analyzing these patterns, and then you can see, right, let's zoom out, let's work our way down all the way down to the entry, and you'll get used to this as you develop more of an understanding of the strategy. For example, if we look at an impulsive movement on the weekly, will we be zoomed in? Right, and we're looking at this from the top down. So let's say we're on the weekly, we then go to the daily, then we're going to see on the lower time frames an impulse correction, and we're going to see them on the smaller scale. But it's really important to understand that what may look like a correction on, let's say, the daily, it could look very different on different time frames, which is why we always zoom out to say, you know, is this the impulsive leg? and within that there'll be smaller corrections, etc, etc, and this helps us build a picture of what is actually happening, but utilizing multi-time frame analysis the whole way through. Now let's take a look at how we can combine that on the chart, so you can see how we start from the higher time frame and work our way down to the lower time frame. So now let's take a look at multi-time frame analysis. So you understand your impulses and your corrections. Well, how can we utilize that to our advantage and utilizing multi-time frame analysis? So what is that? Well, essentially, you're using all of the time frames and combining them to align with your position. So as you know, we use the monthly, the weekly, the daily, the 4 hour, the 1 hour, and the 15 all the way to the entry point. Now you have to understand that you don't always have to use the monthly. Mainly we use the weekly, daily, 4 hour, 1 hour, 15. The monthly does give us a bigger picture, but that's how we do that. So how can we utilize that with this example? So we have dollar yen and we're here on the weekly chart. Well, let's take price back to here. What would we have been looking at this point? We go to the next candle and you can see that we have this low here. So just marking this on, this relevant bit of price, we understand our phases. So as you can see, we have our impulse, our correction. What would we be expecting next? Continuation. Impulse, correction, continuation, targeting this low. So what we do is we're working our way down. So we've gone from the weekly. Right now let's take a look at the daily. What is not visible on the weekly may be more visible on the daily. See how you can see the patterns even clearer now? And you can clearly see, as I stated before, in an impulsive leg, it doesn't always have to be one big momentum. You can see we have impulse, we have a correction, impulse, and then it starts that move. But you can see overall that's the impulsive leg. This is the correction for more continuation. So you're just working your way down. So now to the relevant bit of price. We can take the trend line, let's identify, is there a pattern there? As I said, you're going to learn more and more about patterns through this episode. So we have point 1, point 2, point 1, point 2, and we're looking for a sell here to continue this to the downside like so. So now we're clear. We can say, right, weekly, daily, that looks good. Let's look at the 4 hour. We look at the 4 hour and see, well, now this is even clearer. You can see the pattern there. So we've got point 1, point 2. Now we're looking for an opportunity here to take this to the downside, and we're looking at our structure. Then we go to the 1 hour chart. Then as price moves on, and we can play that. So as price corrects, we have our impulses, our corrections. Then we start to move sideways, and we're forming a correction now. Then we start to move up. So as we start to move up, then we utilize the 15-minute chart, and we can take a look at the structure and see, right, let's have a look at the bigger picture. So we've utilized essentially multi-time frame analysis in the bigger, higher time frame structure. So impulse, correction, now continuation. So we've worked our way down. Then we go to the 15-minute chart, and then we see, can we see an entry point here? So we're utilizing it, and you're going to learn more about the entries here. So we're in agreement of the overall bigger picture. We go back to the daily, just as a bit of confirmation for you to look at the bigger picture. And as you can see from there, we've impulsively moved down. So how did we anticipate that move? Well, as you can see, I've utilized multi-time frame analysis to build that case of evidence. Does it mean that you can't take trades if they're not in line with multi-time frame analysis? Not so much, right? Because within this pattern, let's say the overall move, you're looking for a sell, looking for this to continue. Within here, there may be opportunities short term to look for some short term buys. It doesn't mean that you only have to look for sell setups, but just understand, for accuracy, you're going to do this across multiple pairs. So build this into a habit of a routine. Build your way down. You can start from the monthly, but more so weekly, daily, 4 hour, 1 hour, and 15 to build your entry points, and you're always in line with a high time frame structure. That's the most important thing. So then you're not so zoomed in and taking counter trend trades. So what I want you to do is I want you to do this across multiple pairs and start to build this as a habit and a routine. You'll thank yourself later down the line. So as you can see how important multi-time frame analysis really is, and if you can create this good habit from now, this will be something that sustains you throughout. So now moving on to the next stage. So nature theory, structure, impulse and corrections, multi-time frame analysis. Now we have patterns. This is going to be a slightly bigger one. This is where we get into each pattern that we focus on and understanding how important they are. But firstly, patterns, you may have never traded them before. That's okay. You'll get used to them. Patterns are the basis of the Falcon strategy. Nature theory plays into these patterns as an understanding of the behavior of what price is doing, and it leads into what is forming and why it's behaving in that certain way. This is how patterns are so important. There are a list of patterns that you're going to learn. Our mission is to make sure that you can identify the phase that price is within every market condition, so you can build confidence when you're executing these positions. Patterns fall into one or two categories. We're either looking at continuations or we're looking at reversals, and they come in various forms. Continuations are the continuation of an existing trend. So if we look at continuation patterns, they are a continuation. So if we see an impulse, a correction, and then we see an impulse, the impulse, correction, continuation. Reversals, on the other hand, are the end of the trend and the start of another. So let's say, for example, we're looking at a reversal structure. We could have been trending to the upside, then we create a reversal structure, and then we start to impulse to the downside, and then we create a trend to the downside. So what I want to do now is really take you through each individual pattern that we focus on, how it behaves, why we use it, and how you can learn to spot that. So really take notes on the pattern side of things. So let's take a look at that visually on the charts. Right guys, so as we get into the pattern side of things, it's really important to understand all of the variations they have. So what we're going to do now is we're going to focus on the patterns that we look at the most and all of the different variations, and of course you can then test them as well on multiple different pairs. But let's start off with bear flags. Right guys, so before we get into the price action, it's important to understand the mechanics of what a bear flag is. So quite simply what you'll see is you'll see momentum to the downside, which is the pole. Then you'll see a sideways consolidation, which is the correction. This will be the flag, and then you'll see heavy momentum to the downside. So essentially impulse, correction, continuation. This is what we're focusing on. So with the overall bear flag, you're going to see this in various sizes. So you'll see a larger flag like this, you'll see tighter flags when you'll see very small corrections like so, and you'll also see flags that are much steeper like this. So there's all different kinds of variations, and it's important as you as a trader to know which one to focus on and how do you focus on it. So first up, let's start off with tight flags. So with the first type of flag, we're going to be looking at tight flags. Remember, it's important to utilize multi-time frame analysis. Looking at the high time frame structure is key. So if we look at price before we push down, we have this consolidation here. So this is just one big correction. We finally commit, we have our impulse, and then we have our tight flag. So this is what you'll commonly see at the top and at the bottom of structures. So remembering that the first tight flag has the highest probability of playing out. So as we have the first impulse down, you can see we have this tight correction here. Usually what we're looking at is quite a flat correction and a minimum of 6 to 8 1-hour candles in order to give us the indication when to take the trade. So if we take a look at it here, we can play price back to here, and we can see at this point we've had our first impulse. Now we're looking for continuation, and we're counting here. So we have 1, 2, 3, 4, 5, 6. This is where you have to use your initiative and say, well, we've had 6 hours, do we place the trade now? Not yet. We haven't really got a confirmed bottom. We're just looking at the flag. Remember, it's a minimum of 6 to 8. It could last 12, could last 14. So now we've got a bit more price action. We can see we actually have something here where we can connect the wicks, and then we've got a bit of structure to it. Now we've had enough time for this to play out. What we can do is we can put our entry order, usually just a couple of pips below, and then you have your stop above here. So above this previous high or wick or anything that you can refer to. So let's say, for example, we're looking at this to enter just a couple of pips below, and then we've got 30 pips to be conservative. Once you get your skill set up, you can work on actually refining these and getting these even tighter. But let's say, for argument's sake, 30 pips as we play out. So a couple more hours, 3 more hours, 4. So you're tagged in after this. So as you can see, it's not always 6 to 8. It can last a little bit longer. You're now tagged into the trade. Let's play that, and then we start to play out. So as you can see overall, quite simply, what you're looking for with your first flag is these ones. These are the type of flags you're going to be taking more so than any others. These have the highest probability. They're very simple, they're very clean, and you're just looking for simple impulse, correction, 6 to 8 hours. Set your entry a couple of pips below, have your stop above the high. So for example, you may have a flag in which that you have an impulse down, you have the correction, and you're able to get a very clean bottom of the flag and top of the flag like so, and it'll be very, very tight like this. You have your entry below like so, your stop above here. That gives you an indication where you can put your stop, right? Every single bit of piece of price action will be slightly different, but just understanding the mechanics, that's how you'll do it. And then you'll be taking these type of trades. And then moving on from that, we then get into a slightly different style of flag. So this is more of your flat flag. Now let's take a look at steeper flags. Right guys, let's take a look at steep flags. So essentially they look like this. So you have an impulse down, and the flag will be much steeper than what we just looked at with the tight flags. So these are the ones that you want to avoid, not because they don't work, but over a large sample size, they tend to tag you in and tag you out a lot. So you're rather focusing on more cleaner flags that will give you a higher probability and a higher strike rate. So essentially, why is that? Well, before we look at the actual setup, think of it like this. You've probably heard of things like head and shoulders patterns. If we take firstly a head and shoulders pattern, like so. Let's say, for example, you're looking to trade this, and then we have the neckline. Well, this is where a steep flag could come in handy, like so. We have a break, like this, and what would we wait for? A retest of the neckline. We don't always get a retest, but if we did, like so, that can be a steep flag. So if you think of it like this would have a much higher probability of playing out to the downside versus a steep flag in a different scenario. So these are the two rules that we focus on. Let's say, for example, you've got an ascending channel, quite similar to what we have here, right? So you've got price in here, and then we finally get our first impulse out. But instead of having a flat flag, which has a higher probability, we get more of a steeper flag. Why is this not as good as focusing on this retest here? Well, essentially there's nothing to retest, so you have more chance of, let's say you set your entry below, tagged in, tagged out, and it just creates a larger correction, a bigger version of itself to still play out. What this does is actually lead to more frustration because your direction you picked is actually correct. You're just taking an unnecessary 1% loss, affects your psychology, and then you're unlikely to take the next trade. So it's more so understanding that you're more likely to be tagged in and tagged out. How you can take a steep flag is more so asking yourself a good question. So for example, let's say we have an impulse out and you do take a steep flag and you do decide to take it. It's not that it can't work, you have to be more on your game for the management. Because let's say you don't get tagged in and tagged out very quickly. You could take a steep flag like this, price could take you in, you're now towards the low. Well, it's working out so far, right? This is when you move it to break even. Why is that? Because this is where you can get a confirmed bigger flag in which this would now be the bottom. So it's the low that's important. It moves back up to create a tiny little kind of double top within the pattern, and then it pushes down. So this is what you have to understand, that it doesn't always move back up and goes lower. So if you're tagged in, it goes to the low, you don't move it to break even. Sometimes it can move back up and create a larger version of itself. So you're better off waiting for the first flat correction rather than getting involved in a lot of these steep flags. It's just going to lead to more frustration than not. But if you look at it from a head and shoulders perspective, you can see that the steep flag has something to retest off. And like again, when it gets to the low, you move to the break even. If it comes back up again to test it, then you just get in with another entry, and then you're protecting your capital in the process. Now, if we actually take a look at this entry here, after the break of this ascending channel that we had, you have the move down, you have the impulse, and you can see tiny little corrections in here. But this is the first point that you get, right? This is your steep flag. Can you see the difference from the tight flag that you focused on? Look at that. So it's much more steeper. Yes, it does play out, and you probably would have taken a break even on this one, but more often than not, you're either tagged in like so, and it creates a larger version, you take a 1% loss, you have a lower strike rate, or you're tagged in and it creates a deeper version of itself anyway. So you're better off taking your tight flags. Even this, for example, as you can see after, move down, tighter flag, and it plays out much better, and you would have walked away with a small profit. So it's just understanding those concepts. Tight flag is the highest probability of playing out, and then of course you have your steep flags. We don't focus on them that much. You can take them, but over a large sample size, I would personally, and a lot of people in the community would say exactly the same thing, to avoid them. Right guys, now let's take a look at the larger flags. Right, now let's take a look at larger flags. So as you can see here on pound dollar, we've got the overall bigger double top, and we've been looking for a selling opportunity on this. Now, as you can see here with this ascending channel, what do we get? Well, we get the break of this ascending channel, we have our impulse, we have our first flag, which is our tighter flag, as we spoke about. Highest probability, pushes down, and then what do we get? We actually get a larger version of this. So how would we actually take something like this? Well, quite simply, we would do this. We have to understand that not flags are always going to be tight. These are our favorite ones, but they're not always going to be there. And after we have this impulse here, we need to appreciate that we will have a larger correction at some point. So as we play out, this moves up a little bit higher, and then this is where it can form a second bottom. So you wouldn't know that this is a larger flag yet, because at this point we could just move back up to the high again and then sell off. So we need a bit more information. We have to be patient. What happens? Then we start to move off. So now we've actually got this point, and we would have our ray line on just to mark this on as the high. So this is now a value area for us to look for a sell. Why is that? Because the high time frame is pointing to the downside. So we have impulse, correction, impulse. Now this is a larger correction, so it's still a bear flag. It's just a larger version of this to then move to the downside. And we have a double top within it. We have a rejection, and then we can look to set our entry like so. Have our stop just above 30 pips. And how long do we take? So another hour, triggered in. So it hovers for a couple of hours, then it starts to drop. As you can see, it plays out. It's just a larger version of itself. So impulse, tight flag, impulse, larger flag. So as you can see, it's the same mechanics behind it. We're just looking at a bigger variation of it. Now you're going to find this over and over again with flags, and especially with the larger corrections. So always expect it when we're looking at bigger moves, either to the downside or to the upside. More so with the downside, if we're looking at bear flags, we'll always have a combination of tight flags, steep flags, and bigger flags. It's just up to you as a trader to know which ones to take. And these have a big high probability of playing out. So that's the larger flag. Let's take a look at the next type of flag, which has a different variation called the running channel. So the last type of variation that I want to focus on is something called the running channel. Now you have this both to the downside and to the upside. So firstly, starting off with the downside as we're on bear flags. So as you can see, we've got the larger double top here. We just break the high and we have an impulse down. So it's this bit of information that I want you to focus on. So as you know, after the first impulse, what would we be looking for? Tight flags, larger flags, steep flags, etc. Well, this next one is the running channel. So what is a running channel? Well, essentially, it has a slight descending nature to it. So what happens is we have this. You'd have an impulse down, and then you'd have a move up. You'd be looking for some sort of flag. Within the channel, it would form more of a descending structure like this. But at the last part of the channel, what you want to look at is what it gives you. So with the running channel, what you'll see at the end of that is a ascending formation within it. So you'll see an ascending structure like this right at the end of it, because if you put that bit of price action on an area of support, if you like, or at the bottom of a structure, you would see that as a buy setup. But if looking at it in a downtrend, it gives us a bit of a different dynamic. So if we look at it here, we have right at the end this part here, which is the running channel, like so, and then you can see it here. So we have our impulse down, and then we have our ascending structure right at the end here. So impulse down, correction, looks like a descending structure, and right at the end, what do we have? The ascending channel moves up, and then we drop out. And if we actually go to the 4-hour chart, you'll see these smaller and at a bigger degree as well. So if we look at the next bit of price action, what do we get? We actually get the same thing. So it's a descending structure, but what do we have right at the end? As you can see, the ascending pattern right at the end, and what happens? We then drop out. So as you can see, impulse into a smaller running channel, impulse into a larger running channel. Now if you take that bit of price action, for example, and then we clean all that up and we put in something at the low here, you imagine if we take price to here, if we had that same bit of price action, what would that look like? You would see that as an area of support, if you like, and you'd be looking for a buy setup. So it's about understanding, where do we come from? We come from an impulse down, then we form a running channel. The higher time frame is pointing to the downside. What is the clue? It's the last part where you're looking on the lower time frame on the 1-hour chart for that ascending structure there, which becomes clearer and clearer. And you're going to see this across multiple pairs. That gives you an edge to still take advantage of these trades. So it's knowing where we are in the structure is what gives you the clue. Now, all of the patterns that I've shown you today, we actually refine these on the 15-minute chart. But if you're a new trader or you're new to Falcon, I wouldn't recommend you getting into the 15-minute chart straight away. Give it a couple of months, learn how to deal with these structures, and then you can refine that further on the 15-minute chart. We actually have an episode in Quick Tip Season 3 that you can check out after the Foundation series, and that will give you more of an insight as well. But that is it for the bear flags. Go and test it, do your homework, see this on multiple pairs across the board. Let's move into the next pattern. So next up, we're looking at bull flags now. So this is the opposite to what we was looking at bear flags. Here we have New Zealand CAD, and we're on the 1 hour chart. We're going to be looking at a buy setup. So essentially you can see that we have this channel here, and after we get a bit of commitment, we firstly break out of this consolidation, as you can see, and then we get our first flag. So if I zoom in on here and we just get this in first, so as you can see, we've got the break, of the trend line there. If I zoom in, exactly the same as a bear flag, we're looking for that 6 to 8 hour correction, like you can see here. So we have our first impulse, then we have, remember, our first flag, which has the highest probability. So as you can see here, 1, 2, 3, 4, 5, 6, 7, 8, 9, you know, we're looking at pretty much over 10 hours before it goes. More than enough time, whether you're working 9 to 5, it really doesn't matter. The flexibility of the style is key, that you're able to execute those orders. So essentially, if you look at it like this, how would you take that trade? Well, you've got your top there. You can see we've had a minimum of 6 to 8 hours. We've had our first impulse. We've broken out of this channel, and then you'd have your entry just a few pips above, like so. You have your stop below the correction. So you'd have your stop just below here. So we're looking at, to give it a little bit of room for a bit of spiking, 20 would be more than enough, right? As you can see, we clearly clear this point here. And if you did want to put it on, just from a visual perspective, so you can see the flag, as you can see, it's below, right? So you've got your entry on, and then you're targeting here as a minimum. So quite simply, if we go back now to around here, you're seeing it like this. Impulse, correction, here is your bull flag. So just a very typical type flag, same as the bear flag to the downside. These are our favorite flags, as you can see. Here we go. So quite simply, you're looking for that simple type flag. Next up, now let's take a look at the buys on a larger flag, and what does that look like? So now let's take a look at our larger flag. So we know that we have our first impulse, and then we look for the type flag. Well, what if we get a larger version? Well, this kind of does the larger version and the steep one all in one. So let's take a look at this. So we get the breakout of this channel here, we get our solid impulse, then we're looking for continuation. Notice how before we get our entry, what do we have here? So this is the steep flag scenario. So as you can see, much steeper. Can you take this trade? Of course, you can take a steep flag like so, but you have this where you can be tagged in like so, tagged out, you take losses, it keeps going steeper and steeper, and then it goes. It's a lot harder to time, put it that way. So I prefer to stay out of those. And what they can do is they can move back up to the high, create a larger version of themselves, come down, and then I look for the trade at the bottom here before I go long. So that's how I personally look at it, and a lot of people in the community. So as you can see, let's just fast forward that. So essentially, if you did set an order here, you may have already been triggered, or you would have now. So you're triggered into the trade at this point. Right, now we're near the highs. Remember, you can take these trades because some of them do play out, but remember the large sample size. So at this point, you've been tagged in, you've set your entry, and now it's at the highs. Now we come back down, so same deal. As you can see, they create a larger version of itself. So what would we have done there? Well, after it rejected from the high, I was of course waiting. This is actually a trade that I took myself. And at the low here, we had our ray line. And like you can see, impulse up, a larger version of itself. Instead of the double top within the pattern for the sell, we're looking to the upside because we come from an impulse up. Then we're looking for the entry here within the pattern to then take it long. So quite simply, what we would do is we would be buying that like so. We'd have our stop just below here. Some people would have it quite tight. Some people would have a little bit of room for any spiking. It really does depend on your personality and your risk appetite. But if you look at it like this, let's say for argument's sake, we're looking at 25 pip stop. You're in the trade, you're targeting much higher, of course. And as we play out, we then hover for a little bit and then we break out of the flag, come back in just ever so slightly, and then we start pushing higher. So overall, as you can see, quite simply, you're looking for the simple mechanics of impulse, correction, continuation. Do we know whether it's going to be a steep flag, a tight flag, or a larger flag? No, nobody's going to know that information. But by us understanding those variables is key. So as you can see, avoid the steep flag, be a little bit more patient, then you get the entry, and then bank the profit. It's a tiny 1% tweak, which makes an overall big difference in your performance. That is the larger flag. Again, go and test those and the steeper flags. Let's take a look at the running channel to the upside now. Right, now let's take a look at the running channel. It's important to have a bit of context here. So as you can see, we've got the pound dollar. We're looking for buys with this longer term trade to the upside. So within this area, we have our first impulse up. We're looking for, like I said before, tight flags, larger flags, etc. What is the running channel? Well, the running channel, the same as what you just saw to the downside, it's exactly the same as it is to the upside. So essentially, it will come from a move up, and what you have is something that almost looks like a reversal that you might be used to seeing, like an ascending structure that would sell off. But what actually happens is, at the end of the pattern, you'll have a descending channel. So for example, you'll have a descending channel like so. That will be your pattern, and then you'll be looking for something like this, and then it will actually break out to the upside. It's the end of the pattern is where you want to look for the key bits of information. So if we zoom in now on the 1 hour and see what would that look like. If we look at price here, like we said, we've been looking for moves to the upside. We have our impulse up, we have our first flag. This is not as clean as what ones we've seen before, but as you can see, impulse up, and then our first continuation. Then we have our slightly different flags, not the cleanest, but we can still see continuation. And what do we have here? This is where we see our running channel. So as you can see, it's got more of a ascending structure to it. And in the right area, you could see this as almost a sell setup. But because we know the high time frames are pointing to the upside, and what do we have? We have the descending channel at the end of the pattern, like so. We're able to then enter that at this area here with our stop just below here. So you're looking at probably around 40, anywhere between 35 to 40 pips. Let's say 40 pips, and you're looking for upside. Arguably, you probably would have walked away with about 4.5 to 5%, anywhere between then with this trade as it sells off there. But as you can see, by understanding that and not looking at it black and white and saying, right, that's a reversal structure, that means I have to sell it. Really and truly, it's the running channel is our unique style where we're able to capitalize on these trades within Falcon. It's these little details that gives us an edge, and you have to ask yourself, an extra 4% here, extra 5% there. Imagine that over the course of 5, 6, 7 trades out over the year. What does that do to your overall yearly performance? That's what you need to think about. So quite simply, same as the running channel to the downside, it's the same thing to the upside. Impulse up, starts off with a correction, then it ends with a descending pattern within it to then shoot up, rather than actually this being a sell setup. It's actually a buy setup. So it's a slight small variation, and again, test that across the board. So you have your bear flags and you have your bull flags. These scenarios, these different variations, if you don't understand it straight away, that's absolutely fine. It will take a little bit of time, but once you get it, this will be like second nature. And remember, the most variations that you'll see is with bear flags and bull flags. Once you've got it, you'll be just executing these flawlessly on a subconscious level. So remember, go and do your homework, go and test them on multiple pairs, and you'll become more and more familiar with them. Right, so now let's take a look at ascending patterns. So what is an ascending structure? Well, essentially, it is in the title. It ascends. So you'll see the nature of this will have an ascending feel to it like this. Then you have this on the larger degree and you have this on the smaller degree. Really and truly, we look at this on the larger degree and then work our way down to look at the bigger picture. So let's take, for example, we're looking at New Zealand CAD. So New Zealand CAD here, what do we have with this bit of price action? This was a recent trade that we looked at and that we took. So you can see we have this overall double top type formation here. So naturally, we're going to be looking for sell setups. What helps us in this process? Well, if we can identify a clear ascending channel, well, as you can see here, this is what we get. So if I just get this and draw it on, what we have is our ascending channel. So you can see this on the daily as we work our way down. So now we go to the 4-hour chart. So if we go to the 4-hour, what you'll see is this. Now we can neaten this up. You can see the channel quite clearly here. So what we have is we have the larger degree, and then we can look at the lower degree. So how would you take an ascending channel? Well, it's important to understand that typically speaking, an ascending channel, a clear structure like this, will have 3 sections. So if we take this bit of price to here and we look at it, what we'll really be looking at is section 1, section 2, and section 3. So as you can see with the overall structure, you'll have the middle part, which will be the correction. So it makes up the overall pattern. So you have an impulse up, a bigger flag, an impulse up. But as you can see, the overall move, even though it has an element of impulse, correction, impulse, it makes up the ascending channel. Now this is a very, very clean ascending channel with the 3 sections. So as you can see there, you have 1, 2, and then 3. And it happens to line up with the double top, the ascending structure, which is the reversal for the downside, then we're looking for sell setups. So naturally, that's how you can see how we build the picture. So how do we take that one step further and then look for sell setups within that? Because the first point of entry is that when we go to the 1 hour, it's the area of value that we're looking at. So we know there's 3 sections to it, and we can see we have 1, 2, 3. So how would we typically take that trade? Well, it's important to understand that it's the area of value that's the most important. So let's say we took that, let's be conservative and say 25. Depending on your skill set, you could get that even tighter. What we would look at with the 90% rule is look at the low here. So we'd look at this. So 90% of the time, it will fill this correction here. So it will go all the way to the beginning of the correction. What that does for us, it gives us a solid target, and we'll be looking for a risk to reward at about 12, nearly 13% to the downside. That gives us an edge, understanding that structure, because what people will tend to do is close trades down early because they might think there's an element of support. For example, they might have something in here and look back and think they're rejected here, and they'll close the trade down early. Really and truly, we had a 90% probability would get to this low, which gives us an edge there. So that's one element to it. So as you can see, that would be a simple way to take it. Well, emphasizing the fact that with the unique style of Falcon, there's multiple entry types. So now we can remove the ray because we're just looking at the pattern itself. We also have patterns within patterns. Now, I refer to this in one of our quick tips episodes, so definitely go and check that out after. It's a full episode on patterns within patterns and how powerful they are. But let's take a look at this. So now we've got the overall larger ascending structure. Well, we also have tighter ones of those. So this would create the pattern within the pattern. So whenever you see an ascending structure within an ascending, so what we call an ascending within an ascending, that gives the probability a much higher degree. And what do we have when we take that bit of price? We can literally take this price here and look at it the same way. So on the larger degree, when I said 1, 2, 3, what do we have? 1, 2, 3. This being the middle section of it. So move up, impulse, correction, move up, third touch, and then the drop. So as you can see, we have that matrix of the patterns within the patterns. And when we have a pattern within a pattern, the probability is increased. But note that even if you didn't get the first entry, you can then take it on the break as the second entry. You can also identify that we have our impulse, our correction, just like we looked at previously, our flag. So you've got our first flag to take as well. So not only do you have entry 1, entry 2 on the break, entry 3 on the break of the flag, you also have the ability to recognize that we have a head and shoulders here as well. Left shoulder, head, right shoulder, and on the break of the neckline. So when you know the bigger picture, you've then got your entry types. No longer do you have to wait for this just one entry to the perfect area. You've got 1, 2, 3, 4 potential entry types. Chances are you're going to get 1 or 2. So you don't then have that fear to constantly feel like you need to get in at exactly the right time, in the right session, the right time zone. There's multiple entries along the way. But quite simply, utilizing the bigger picture, as you can see, a larger ascending structure, then you have smaller versions of them, but it's important that you look at them in the right area. As you can see here, we started looking at this at an overall double top area. If you look at an ascending channel, let's say here, and it's nowhere near this double top, or it hasn't got any outer structures to support it, then it's just a valid structure. It doesn't mean it's actually a valid trade within itself. So look in the right areas, go and test that, look at them on a larger degree, and also look at them on the smaller degree as well. So now looking at descending structures, we're looking at the opposite to what we just looked at with the ascending formation. So we're still here on KiwiCAD, and we're looking at this low here. So if we look at the overall bigger structure, we just broke that low here. We had the low here that we're looking at. So naturally, we were looking for buy setups in these areas. So if we work our way down and we look at the overall structure, we're looking at the larger degree first. So remember, with the ascending structure, this was very clear. 1, 2, 3. We had a really clear middle section here. It's not always going to be picture perfect, but this would be your cleanest ascending channel, if you like. Now, if we look at it here, we still have 0.1, 0.2, 0.3. 1, 2, 3. It's just not as clean as the ascending structure that we looked at, but it still has all of the elements that we look at. The great thing is with the ray line here, what do? We broke the low, which is a good sign, catching people on the wrong side of the market that ultimately trade things like support and resistance. As we break below, we then break back above. So we're anticipating a break back above rather than, right, we've broken support, we're going to retest to go lower. We don't think like that. This is what the masses do that are not capitalizing on trades. So as we go a little bit further, so we can see the descending structure to it. This is a reversal pattern. And when we go even lower to, let's say, the 1 hour chart, the same way we looked at patterns within patterns for ascendings within ascendings, we're looking at exactly the same for buying setup. So we're looking for a descending pattern within it. So as you can see, we have the smaller degree within the pattern. It's the same structure, just on a smaller degree. We can remove the array line, just look at the pattern for now, so you can see this even clearer. So the pattern within the pattern. So how would you place a trade on this? Well, we actually have another opportunity. So the same way I alluded to earlier with the ascending, within the ascending, there was a other setup that we had in there. We also had the head and shoulders pattern. What do we have here? We actually have a mini double bottom within here, and then a break above this little channel. So there's a few ways that you can take it. But let's say, for example, you took it on the third touch. You would have taken this for a buy in this area. You either look for a rejection on the 1 hour or the 15 minute. Let's say you got involved with 25, wouldn't be unreasonable. You would have just hovered around for a little while until it finally then broke to the upside. Or you had another opportunity to get involved where you had the mini double bottom. So how you would take it is like this. You're either waiting for the trade to come all the way back down to here before you buy, or you understand that it doesn't always have to do that. So our override, if you like, to ensure that we can still capitalize on the trade, is the mini little double bottom that you see within the pattern to then take it to the upside. You either take that on the rejection or you take it on the break. So you have a couple of entries there. Let's say, for example, you took it firstly below there. So you'd have your stop there for about 30 pips would be fine. You could maybe get away with a little bit tighter, and then you'd be looking to the upside. You'd be running about 5-ish% right now. Let's say, for example, you took it on the break, then you would need your stop slightly larger. You'd be looking more towards a 40 pip stop, like so, on the break, and then you'd be running about 4%, or a little bit lower than that, 3.6. But overall, you get the gist of it. You're either looking right at the edge or you're looking on the breaks. But it just emphasizes the fact, again, we're looking for the patterns within the patterns, we're looking at the overall structure, and then we're looking at the candle shape secondary. It's the area that is more important, because structure will always override candle shapes. And it's always about looking at it within the area. If you had a descending structure like this in the middle of nowhere, it wasn't supported by any low, it hadn't broken a low or anything like that, it doesn't hold anywhere near as much significance as what you can see here. But like I said before, as you tested on the higher time frame structure with the ascendings, I want you to do exactly the same on the descending patterns, on the larger degree and on the lower degree, and work your way down across multiple pairs. Right guys, so now let's take a look at a double top formation. So this is something that we trade quite regularly. We see this on a bigger degree and a smaller degree. So what I want to show you is what that looks like. So we've got New Zealand CAD here and we're looking at a double top. Essentially, it is in the name. We're looking for a double top. So as you can see here on the left, we have the high. What do? We come back around and we create a double top before we drop. So this is a selling opportunity that we look for. Now we see mini versions of this on the lower degree as well. But you can see this on the bigger time frame. That gives us an indication of where we can look at next to the downside. But we don't always see a typical double top, in the sense that you may have previously traded something like resistance, where you're almost expecting it to reject exactly off of the resistance before it comes to the downside. So what we have is something called an extension of a pattern, in which that you'll see previously, as we discussed, things like the ascending channel on the lower time frame. So if we go to the 1 hour chart, I can show you what I mean here. So as we go to this area, as we're looking for this double top, technically it doesn't just reject off of this area, does it? It just goes through there. Now sometimes you get this on a larger degree, in the sense that it actually extends even further. So it wouldn't be unusual for price like this, for example, to actually extend even further. It doesn't necessarily mean it's breaking to retest to go long. Essentially, it's creating an ascending channel, an extension of it to drop to the downside. So it still comes under the line of a double top. It just goes slightly higher. And on this one, it only just pierces through, but it's important to just note that little detail, so you're not thinking that, right, it's broken and now it's moving to the upside. So what we can see in this, again, just to reiterate this, you can see this ascending structure right at the double top. This just gives us more evidence that, right, we have this top, now we have the double top, we're looking for the sell. And we also have a reversal structure within that gives us even more of an indication that we're coming to the downside. So you'll see this across the board. And then sometimes what we also see is a double top within that. So it wouldn't be unusual to have, let's say for example, price comes down and then it comes back up ever so slightly, and then you'll have a mini double top within the pattern before we get the drop. So that gives us more of a variation. So if I remove the first ray line, sometimes what we see is price move down here, then it comes back up, creates a mini double top. It's on a much smaller degree from what we just looked at, and then we get the selling opportunity. That's good for us because a lot of the times if you don't get the first entry, we have another opportunity to get involved in the trade. So as you can see, double tops, keep them simple. We have them on the larger degree and the smaller degree, but we also have things like triple tops, quadruple tops, but predominantly what we focus on and what we see more often than not is the double top. Sometimes you'll see exactly the same thing where we have 1, 2, this could come back down, maybe come back up again, and you'll have the triple top. But generally speaking, on the higher degree and the lower degree, we're looking for the double top. So very clear, go and mark them on charts, and I'm sure you're going to see them very regularly. Now let's take a look at the next pattern. So now taking a look at double bottoms. So this is the same but in reverse of double tops. So of course we have them on the larger degrees and the smaller degrees, and we of course also have some triple bottoms as well. But overall, taking a look at the structure here on Aussie dollar, as you can see from this very large wick, that we've filled this wick and we've created this overall double bottom type formation. As you can see, we go just a little bit lower as nothing is perfect. So we want to show you the reality of the market rather than these picture perfect type examples. So let's say for example, you previously would have had this ray line on here just to mark on that low. We just come down here, but how do we actually approach this overall double bottom area? And why is it so relevant to us? So why we'd be looking for this? Well, if you look at the overall structure leading up to here, and we study that bit of price, you can see that we have a descending structure all the way down. And what do we have? Another descending structure. So we've got a pattern within a pattern, which gives us a higher probability for more upside. When you combine that with the fact that we have this overall arcing, lovely double bottom formation, that gives us a much stronger indication of what's going to happen next. So now if we just remove the ray, just so you can see this in a little bit more detail. So as we zoom here in the daily chart, we can see we previously had our double bottom, a smaller one within here, and then what do we have? We have the triple bottom. But overall, as you can see, it is a larger, more significant, bigger double bottom in the sense that this is section 1, this is section 2. So you can see one significant part, two significant part. But even within that section, you'll have the mini double bottoms, triple bottoms. Sometimes it might even come down for a fourth touch. But overall, you can see this is a strong indication that right now we're looking for buying positions, and there's going to be some momentum to come to the upside. So that's why we're looking at it. That's why we're identifying it and seeing if we can get involved in any of these trades. So when we combined all of that, and then we have our patterns within the patterns, this gives us even more evidence to suggest that we're going to get more upside. So as you can see, after price moved away from this double bottom area, this kind of mini double bottom area, it pushed up, come back down for the triple bottom, and now we're moving up and expecting more upside on the larger degree. So when you can combine these and spot these, you're going to see them, of course, on larger degrees and smaller degrees. We're going to see these even on the 1 hour chart. So sometimes you'll see them like so. Some things that are not really visible on the, see, we didn't even see that until we just saw that there. So as you can see on the third touch before this moved away, so if we just pop the ray line on like so and go to the 4 hour very quickly, see, it's not very visible here, right? But you can see section 1, this nearly makes it 1, 2, 3, fourth touch. And then when we go to the 1 hour, you can see before we push up, what do we have? We have a mini double bottom before the move up. So as you can see, you have them on the smaller degree and you have them on the larger degree. And this is just more for precise entry. We push up, and then as you can see, we start to create these extra patterns that we look for, which you're learning in the episode. So overall, keep it simple. Plot these on multiple pairs and you're going to see them quite frequently. But when you're looking at it from a high time frame perspective, that gives you a much bigger picture and larger indication. Then you zoom in and you look at the lower degree, 4 hour, 1 hour, etc. And then you can get much more precise entries to get that bigger risk to reward. So I hope that helps. Go and backtest that and see that for yourself, and you'll get much more clarity. Let's move on to the next pattern. So now let's take a look at the Falcon flag. So first, it's important to understand what is the Falcon flag and how can we utilize it to our potential. So essentially, the Falcon flag, where did it start from? It actually started from a management tool. So let's take a look at our first original impulse and looking at our first flag. What used to happen is, years back, what I used to do is I used to look at these flags as a sell, and sometimes what used to happen is I would pick the direction very well. It would impulse down, and then it would retrace, and then I would take an unnecessary, sometimes 1% loss. And then after looking at the data and realizing, right, how comes I keep taking these losses, what I started to do is I created something called the break-even method. So what started to happen is I realized, well, if price retraces after, let's say you've sold this and it retraces right back to the entry, rather than letting it take me out for an unnecessary 1% loss, I can secure myself to realize that, right, something's changed and I can take a break-even. So that's the simple mechanics of how the Falcon flag started. So how did it evolve? Well, I'm looking at data again and I'm seeing a similar thing and I'm picking the direction, but what's actually happening is I see an impulse, I see a correction. So I take the first flag, as I alluded to earlier, it impulses down, it retraces, I take a break even, and then what started to happen is I started to see sideways consolidation, almost a larger version of the original flag, and then it would still play out. And then I couldn't work out, well, I'm picking the direction, but how do I get involved in these? And then I started to realize a key detail, which is what I created and recognized as the Falcon flag. Essentially, it starts off as an impulse, a correction, but you don't know it's a Falcon flag until you've taken the break even, essentially. And that gives you an indication of what's happening next. So you take the sell, it impulses down, it retraces, you've likely taken a break even at this stage. It will come back down and then create essentially a double bottom within the pattern, then move back up, and then you're looking at this as either double top, triple top, and then looking for the sell. Now the Falcon flag has a few variations. It's not always going to be picture perfect, but essentially it is a big bear flag, but it's a larger version of one, and it starts off with a tiny correction first, impulses down, and creates a larger version. Sometimes you'll have the same thing. It'll impulse down, it'll correct, impulse down, retrace, and as it comes back down, you'll even have a hover at the end of it, which is another flag, giving you another indication to be able to get in the trade. So it creates a much larger version of itself. So there's a few variations, and it's important to understand them so you can still capitalize on the move. And if we take a look at this structure here, it wouldn't be unusual for us to be looking for a sell after this ascending structure. So after this ascending structure, impulses down, what would we be looking to take this? We'll be looking to take this to the beginning of the correction as an absolute minimum, right? So knowing that we're looking for sell setups, what would we be looking for? Tight flags, areas in here to take for a sell, larger flags. Well, what if we get the Falcon flag? And that is what we have here. So as you can see, if we take price back to here, what would you have been looking at? Exactly what I explained. So you've got impulse, you've got a correction here, impulse here, a flag here, and what happens? It creates a larger version of itself and still plays out to the downside. So if we just play that, moves down, then moves back up, then creates the squeeze, which is essentially the second bottom. You may have previously had this like here, and eventually you would have got the angle once we got a confirmed push off, and then we've moved up 1, 2, 3, and you would have been able to get an entry within here as well. And as you zoom in even tighter on the 15-minute chart, you'll have even more precise entries. So as we squeeze, then we drop, and then we're looking for that 90% rule as a minimum, as you can see, and then we start to create other patterns. So within there, as you can see, quite simple, all the Falcon flag is a larger version of a bear flag, but understanding that bit of variation, that knowledge, gives you more of an indication to be able to be 10 steps ahead of the market, and realizing that just because your original trade doesn't work out instantly, this could develop into a much deeper correction and still go in the desired outcome that you expected. And then if we look at price previously, we're always going to have very very many variations of the falcon flag, and they're going to come on larger degrees, they're going to come on smaller degrees. So what I would like you to do is spot that for yourself. I mean, even going to this bit of price action here, we can see another version of it that slightly expands a little bit. So you see how we get the correction there, we impulse down, we retrace, we impulse down, we kind of create that double bottom but more of a slanted degree, and then we have 1, 2, 3, we impulse down, and then we have the hover, and then we drop. And we also create it here where we get a tiny correction there, impulse down, retrace, we create a larger version of itself, and then we drop. So you can see this happening quite regularly, right? So you need to look at it on the higher degree and the lower degree, and the more you can spot that, that just gives you more of an edge to realize that your analysis is still playing out. It may just not be playing out straight away, and there are other opportunities for you to still capitalize on the move. This goes for the same as the inverse, so you can see this on the flip side, in the sense that you'll have a move up, a correction like so, it'll move up, it will retrace like this, and it will be a bigger ball flag to the upside. Predominantly, we don't really focus on the inverse of this, so we don't focus on this to the upside. We're mainly looking at it to the downside, as that's where we find the highest probability. But this is a thing, and it is available. But I would focus more so on the sell setups. They're far more powerful. So I hope that helps. Definitely go and check that out on more pairs, so you can see that for yourself play out over and over again. And on that note of looking at the higher degree, let's take a look at that on a dollar yen. So as we can see here on the bigger picture, looking at the falcon flag again, what do we see? Well, if we take a look at this bit of price, this is the most important bit of price. So naturally, it's important to understand why we're looking at it. Well, if we just mark on the overall area here, this previous low, we're looking for price to come back down and test this low to create this overall bigger double bottom. Now, as you can see within here, we start to form, let's take this back to here. This is on the daily chart, and we're looking at impulse, correction, and we're looking at a flag, either to take this to the downside or create a larger version of itself before we drop. So we just play that out. We move down, create a second bottom, move up, triple top formation there, and then we push down. So as you can see, there is the falcon flag. Let's actually draw that on so you can now see this in clearer detail, and we'll go to the lower time frames like so. So you can see it starts off with a correction, pushes down, pushes back up. We essentially get different variations. They're not always going to be picture perfect. This is actually much cleaner. As we go to the 4-hour chart, this was the trade that we capitalized on. This was a very nice trade. And as you can see, we previously had this like this, section 1, section 2. We just break above, and then we have an ascending channel within that, which we expected to the downside. So looking at it from that perspective, we have 1, 2, 3, ascending channel within it, bigger falcon flag that originally starts off as a correction, that pushes down, comes back up for a break even, just creates a larger version of itself, and then it drops. So as you can see, falcon flag has a lot of substance to it, and if you can identify it, you can position yourself in these trades that are very powerful. So now you can see on the higher degree and on the lower degree of what they look like. Let's actually take a look at how frequently they pop up. Now let's take a look at expanding formations. So these are things that we actually look for quite often. We see them on the higher degree, we see them on the lower degree. Here we have pound Aussie. It's important to look at them at the bigger picture and look at them on the smaller picture. So let's start off with this example. So as you can see here on pound Aussie, essentially what you have with our expandings, you can see them quite frequently, and what you'll notice is that you have lower lows within the pattern and higher highs within the structure, which essentially gives it that expanding type structure. One thing to note here is you can see this obvious, very clear, huge volatility spike, which is just essentially a flash crash, something you ignore. And another reason as to why is that we focus on drawing our trend of the patterns to the wicks, but of course we wouldn't do this for this example. If you see volatility like that doesn't really make sense, it's not really relevant, we completely ignore it. So that's why we just can look at this, it's still exactly the same structure. So within expanding, you can see that we have the formation, we have point 1, point 2, point 3, and essentially right at the end we actually get a double top within it before we start to drop to the downside. Now on this example, we want to show you that not every single one will complete the whole move. So we was targeting this double bottom within the pattern. We filled pretty much 90% of it, which is the gauge that we look at, but not every single one is going to fill the same thing, but it can still be profitable because there's still a lot of percentage to make on the way down of that move. So that's what we look at with expanding structures. You can see there on the larger degree, and even here just looking left a little bit, it's really important to always look left and see how these patterns repeat themselves. I mean, if we look at the expanding on a slightly smaller degree, as you can see here, one variation that I would mention about expanding is that they don't always have to expand hugely to the upside. As long as they've got the lower low within the structure, it still has that expanding feel to it. So as you can see within this, it doesn't really have a higher high in that sense, but it's more so a double top within it, but it still has that expanding feel to it to push to the downside. So as you can see, impulse down, continuation, and this almost has that running channel type feel to it as well, with the ascending structure right at the end of the pattern to then drop out. So it's a no-brainer why this would continue to the downside. As you can see how powerful they are when you can spot them on the higher time frame and on the lower time frame. So that's pound Aussie. Let's take a look at another example. So next up we have euro pound. Let's take a look at this in a little bit more detail. So we was looking for euro pound to the downside after this bigger double top formation. Now within the impulsive leg down, we're going to have lots of variations of patterns in this impulsive leg to the downside. So if we zoom in a little bit more detail and we look at this expanding here, after this push down, it wouldn't be unusual to be looking for type flags, larger variations, falcon flags, or expandings. So if we just pop on this low at this point and we take price back to around here, so at this point we can identify, right, we've got the break of an ascending structure. Again, 1, 2, 3, clean structure, just breaks above the high, catching people on the wrong side of the market. Impulse down, smaller flags on the lower degree, which you can see on the 1 hour and 15 minute. And then we have a larger flag, and then we get what we can see here as an expanding formation. So let's just play that out a little bit more. Right, so now we have the expanding structure. As you can see, we have the high highs within the patterns and the lower low within the structure. And now we're looking for more downside, because why? Impulse down, correction, impulse, correction, which is an expanding structure for more downside. As you can see here, we go to the 1 hour chart, and then we have our entry point for more downside, like so, targeting this low as a minimum. And then as we play out, we push down, and there'll be a few entries on the lower degree, but just giving you the picture of the overall expanding structure of how they behave. So looking at that picture overall, you can just see lower lows within the patterns, higher highs within the structures. And then again, if you can spot these more frequently on currency pairs, you're going to see them that they're not always this large. You're going to see much smaller ones in the sense that they might only last, 24 hours, or you'll see ones like this that last a few days, they expand, but always look at the direction. So for example, how did we enter the expanding? Impulse down, correction, impulse down, expanding, continuation, so you're expecting more downside. So it's the same on the flip side of looking at expanding formations to the upside. But to be honest, we tend to see a lot more of these on the way down. So yes, it still applies to expandings to the upside, but you'll find that more frequently we'll see expandings to the downside. They're very, very profitable. So go and plot them on charts across the board. Go and look at them on lots of different currency pairs. So then you can see the variations within them and see the entry points of how you can get involved. So now moving on to head and shoulders, it's important to really understand how to utilize them. So in Falcon, do we use them? Yes, but slightly differently. We don't get too caught up into the higher time frames because they can take a long time to play out. So let's take a look at this example with euro pound. So essentially, what is a head and shoulders? Well, I'll just point on a very brief one. So you have the left shoulder here, you have the head, and then you have the right shoulder. So you'll see this on higher degrees, lower degrees, but it's important to not get too caught up into them. Why? Because you'll ignore key signs within the markets. What you'll do is you'll see the head and shoulders pattern, but you won't see what else there is. So if we take this bit of price and we study this, what else do we see? Yes, we see head and shoulders and we see a neckline, but what you do also have here is a double bottom within the pattern. You have a descending structure that is actually a reversal to go higher. So if you're too caught up into, well, this head and shoulders, it has to play out to the downside, well, you're going to ignore the fact that there's a descending channel structure that can push to the upside and then target this for a buy. So you can see how on the higher degree, it doesn't really serve too much purpose because you're not going to have these huge stop losses. So it's unlikely that you're going to utilize it anyway. If we do get a clear break, so let's say, for example, we did get a clear break and then it pushed back up for a retest, which doesn't always happen. That's a different story. But looking at it on the larger degree and then having this kind of confirmation bias that, yep, looking for a sell, you'll ignore these profitable signs. So definitely take a look at it from that perspective. So that's it on a higher degree. Now let me show you on the lower degree how we utilize it. So now let's take a look at how we utilize it within Falcon. So here we have CAD Yen, and what we're looking at here is this double top formation. This is actually a recent trade that we took in the community, and let's build on this. We're actually utilizing this on the lower degree. So as you can see here, we have the double top formation and we have the ascending structure like so. 0.1, 0.2, 0.3. So we've got some decent confluence to expect this to come to the downside. So where do we utilize the head and shoulders? We can see this squeeze of this ascending channel. We just break above the high. Again, mass psychology, getting people caught on the wrong side of the market. They're trading things like resistance, as we're expecting this to break above to catch them on the wrong side and break back down. As we go to the 1 hour chart, you can see that we get this squeeze right here. So we have this ascending structure. So it wouldn't be unusual for us to be looking for this sell because we've been monitoring this for a while. Now we know there's multiple entry types within Falcon, which gives us the opportunity and flexibility to not have this kind of fear of missing out. There's only one entry. Now what you'll see on a lot of ascending channels, and I want you guys and girls to back test this for yourself as well, is we will see this structure. Right at the top, the most powerful way to utilize it is that you'll see left shoulder, head, and right shoulder. Neckline, move to the downside. Now, quite often, a lot of people are waiting for a break and a retest. It just never comes with the overall impulsive move because the market's not waiting around. It's impulsively moving to the downside. So essentially, you could say that what we're really looking at is the impulse correction and the tight flag that you've learnt about for the move to the downside, targeting this area of the low for the 90% rule. But what we also need to understand is that if we rein in the pattern and we look at the structure, you'll see that the most profitable head and shoulders that we found on the 1 hour chart will happen here. So left shoulder, head, and then right shoulder, like so. And then that way, you're not always waiting for, right, I need to wait for a break and a retest, which is probably the myth that you've been taught before. The truth is, a lot of times, it doesn't even give a retest, but what it does give us is different types of entries. So how we utilize this is we recognize this is an ascending structure. We've got the higher time frame, bigger double top. We're looking for this move to the downside. We've got our first impulse, and then we've got our first flag, but we also recognize that we have a head and shoulders structure within here that gives us even more evidence to take this trade. So you can see how when you stack it in your favor, it can be super profitable. So go and check this out on ascending channels. It is a game changer. So now the last part of the head and shoulders is the inverse. So this is essentially the opposite. So you'll have left shoulder, head, like so, and then you have the right shoulder to the upside. So essentially you're looking at this to move higher. So again, a lot of people are waiting for a break, a retest to then move to the upside. That's what you're looking at with the, picture perfect. The reality of the market, it doesn't move that way. There are variations and you have to have a strategy to be able to deal with that, which is what you're learning. So as you can see here on Aussie Yen, this example, what do we have? We have the larger double bottom formation and we have the overall descending structure, and we're looking for more upside to target the minimum of these highs. Now, as we zoom in a little bit further, we go to the 1 hour chart. It gives us the opportunity to look at this in more detail and see how can we capitalize on this position. So as you can see, we've got the overall double bottom, the descending structure, and essentially what we have here is the head and shoulders formation. So what do we have? Left shoulder, the head, and then we have the right shoulder here, and then the move to the upside. So quite simply, what have we done there? We've combined double bottom, descending structure, higher time frame, and then we've the line in the sand essentially, and the added layer, the cherry on the top, if you like, is this moving to the upside as we have an inverse head and shoulders. So we're just stacking it within our favor to be able to take. So getting involved in these positions can sometimes be a little bit more tricky, which you're going to learn more on entry types, but essentially a similar thing. What did we have here? We had left shoulder, we have the head, and then we have within there, which is the flag like so, and then this just becomes actually overall an expanding formation to the upside, which you don't see often, as we prefer to look for expanding to the downside, but you can see it there. Then we have the larger flags, and then on the 15-minute there's multiple entries along the way. But essentially you get the point. You can see that Head and Shoulders, on a much larger degree, they can take a long time to play out, and sometimes they don't play out. But when you have a move that you're already expecting, so you're already expecting the buy, you can utilize that to your favor. Zoom in, go lower and lower, building that picture, because you've got more than enough evidence to look for a buy. Then you're utilizing the fact that there was an inverse Head and Shoulders within a descending structure where you're already expecting a buy. So you can see how you're using it to essentially complement what you're already doing. That's how we utilize Head and Shoulders patterns, Head and Shoulders patterns within Falcon, and we utilize them on the 1 hour degree as the most common place to look at them. But we can see them on the higher degree, we can see them on the lower degree. So I hope that helps. Definitely go and check that out on multiple pairs, and again, use it to complement what you're already doing. So we are back, guys and girls. So hopefully you've now fully understood all of the patterns that we focus on. Now, I can totally appreciate there was a lot of patterns there, but it's really, really important that you go over them as much as possible, and you're going to see how important they are and how much role they do play within the markets. There are so many more patterns than that, but we found these to be the most profitable, and these are the ones that we focus on. And if you can do it the right way, that's the most important thing. Now, moving on from patterns, I want to get into the last part of part one, which is evolving. Evolving is a very, very key component of trading, and it took me years and years to actually learn how to do this. So evolving, this is a term that you're going to hear in nearly every piece of Falcon content. It refers to taking a message from the market and making slight adjustments to your analysis and utilizing things like nature, which you've learned. So we utilize trend lines and ray lines from the market structure. And then as price develops and it begins to create into a new structure, we're also utilizing that as well, combining everything that you've learned. This allows us to keep clean charts and deleting / moving old analysis rather than keeping our charts, messy. We keep them tidy and relevant to what the actual price is showing us at that time. And therefore that gives us a higher sense of probability. By evolving our structures, it leads into the topic of pattern separation, which is a key term and something that you'll learn within the Falcon strategy and within the content. When it comes to pattern separation, this is one of the biggest things that you're about to learn, because it keeps everything relevant. And if you can keep things relevant, it gives you a much higher accuracy as to what is going to happen next. So what I want to do now is show you firstly what evolving looks like on the charts, when we would do it, how we would do it, and more so why we would do that. So let's take a look at that. Right, so now we're going to talk about evolving and how we evolve with structure and patterns and why it's important. So here we have pound CAD and we're on a daily chart. So before we get into the structure, so you can learn how you can evolve with structures and why it's important, let's take a look at why it happens. So essentially, a lot of you will be used to trading with things like trend lines, etc., and you may take them as gospel in the sense that if it breaks a trend line, you feel like the trend is changing. So let's take a look at this. Let's say we have a move to the upside. We have an impulse and then we're having a correction. You're looking for this to, let's say, push to the upside so you can start to draw your trend, right? Now, sometimes we will have larger versions of this and shorter, steeper versions of this. So let's say, for example, price comes back towards the trend line and you think, well, there's 1, 2, 3, and it kind of goes through price like this. Then you're thinking, wow, the trend's changed. You start chasing the trade. It feels emotional. Then it breaks back above. Then what do? You evolve with the structure. So what we're looking at is the most recent 2 significant touches to help us understand what is the most accurate form of the pattern. So we evolve. Why? Because we studied the price section here. So we can ask ourselves the question, if it breaks the trend line, how did it break the trend line? Did it break it correctively? Because if it broke it correctively, it means there's been no progression. And if there's been no progression, it's likely to then move back into the pattern. And then what that does is it starts to give you a more developed structure that we can look at to see, right, now this is forming an ascending channel that will look like it's turning into a reversal. That kind of primes you ready to take the trade. So that's just the simple mechanics of it. Let's take a look at it on the chart. So if we go to pound CAD here on the daily and we look at this structure, it wouldn't have been unusual at a time if we just take the trend to have a very, very steep trend line here, right? So if we just zoom in, we can see that we've got this here. Let's neaten this up. So essentially at this point, you can see that we've got 1, 2, 3. You can see it's just a very, very steep trend at this point. And if we just take price back to here, it wouldn't have been unusual for you to think, well, maybe this is constantly climbing, right? And you're using this as a trend. This is where the emotions kick in for people. So let's say we break, right? We've broken the trend at this stage. Now, is this a change of trend? Or are we expecting this move to the downside? Well, let's see. We move lower, correctively, and certainly at this point, as we move a little bit lower, we start to feel like we're chasing the trade at this point. This is dropping. You're expecting it to go all the way down to here. You start forcing trades that are not really there, rather than paying attention to the nature of how we've moved out. How have we moved out from this trend line? Correctively, right? So let's play it a little bit further. We even drop lower. This would really play with people's emotions, when the truth is it's still a corrective structure. Now, as we move back up, you can see we're starting to form a much clearer structure now, and here, this is a clue already. So you can see how we've got this double bottom formation in there already, and we can kind of look at this whole bit of price action as one corrective structure. So move up as the impulsive leg in that sense. How did it break the trend line? Correctively. So you've got this one big correction. So would we be expecting this to go to the downside? Not at all. We would expect this to go to the upside. So when do we evolve with the structure? So do we evolve it now? Do we wait? We want some confirmation of a push to the upside to confirm that this is the angle before we do that. So if we play this a little bit further, now we start to move off. Well and truly, you can see that, look, we're still contained at this stage within this structure where it could still be a possibility that we could drop. So there's no solid confirmation just yet. Now as we start to move up, now we've broken. So now we can confirm we've well and truly broken out of this structure, and we can evolve. Now we have the actual trend. So we just pop this in here. You can see that we're starting the trend, and really and truly, all this was here was just a corrective structure, like so, which has that descending nature to it, and then a push to the upside. But at the time, if you're not aware of evolving and you're just literally taking trend lines as trend lines and blindly following them, then you're always going to be caught on the wrong side. The same way that if you just took a simple ascending channel or a pattern as just a pattern and you didn't know the variations, then of course you'll be in the same situation. It's about you looking at it from a unique point of view, and this is why just knowing trend lines and patterns isn't enough, which is what you're going to learn on a weekly basis and how you're going to progress, and these will get easier and easier to spot. So as we play this a little bit further, so you see how now we correct. Let's get this trend line more accurate. And now we start to touch this area here and push off. So now you can see 1, 2, 3, and we start to move to the upside. So as we're tracking this, we're seeing what's happening here. As we move back up, how do we know when something's changing? So you see how here we've got the double top. So very similar in the sense that we had the double bottom and we had the push to the upside. Look at how we've moved up. Very steep correction in terms of that, but you can see the obvious 1, 2, 3 significant point, and then we get the double top. So what would we be thinking at this stage? Well, we've got our trend, something that is congruent and clear. We can remove this because we don't need all of that noise, but we can identify, and I'm sure you'd all agree, 1, 2, 3, double top. Look at the very obvious gap, the big scoop and the arc, double top formation. What would we be expecting? At least down to the trend line, to then see if we're either going to create a bigger correction like so to the upside, or we're going to break that and move to the downside. So let's see how that plays out. So we just remove this, and then we play moving forward. This is essentially an element of backtesting in the sense that we're looking at this and how we'd react. But as we push lower, now we've well and truly broken the trend, but we ask ourselves the question, how did we break versus how we broke here? See, we broke correctively this way. How have we broken now? We broke impulsively, and now we're forming a bit of structure to see if, right, are we targeting the low now? Now we've had that big obvious double top, and we also have that mini double top, like I've said. So essentially, you could almost call that a triple top, but overall, you get the point. First significant point, second significant point, but there's a mini double top within it before the drop. And these are just fine little details that you'll see more and more. Now, as we play a little bit further, you can see we're starting to form a pattern. So at this stage, what would we be thinking? Well, we're looking at it as, can this break back into the structure? Well, I would see it like this. We've moved down, moved back up. If this forms a corrective structure like this and more of a slightly larger flag, then it may be we're just coming all the way back up to the trend line here, forming a steeper ascending structure as a retest before we drop. But at this stage, we're very close to where this correction started, so I want to pay attention to this point. But I'm waiting for more information. Well, we definitely have the information now, because you can see this gives us an angle and more of an expanding. I'd have this on at the low. That would give me a very good clue as, are we getting a double bottom to then potentially hover and then drop, or are we moving up for a third touch or something like this to then drop to the downside? So then we move up. On this one, we don't quite make it all the way to this double top area, but on the lower time frame, when we get into the entry types, you'll see entries within here to still be able to capitalize and overrides accordingly. But you can see structurally what's happened here. We've pushed down from the double top and we've created a bigger corrective structure, but we've broken impulsively versus breaking correctively. So this is why we evolve with the market, so we can get the most accurate form of price as to what's going to happen next. So now as we push down a little bit lower, I believe we start to create another continuation. As you can see there, very typical. So we've got that running channel type feel to it, but in the state of continuation, as you can see here. Just adjust this. And bear in mind, we're on the daily here, so there's much more entries on the lower time frame, but we're just looking at the structure at this stage and understanding why we evolve rather than the entries. As we push, so we create a little arc there. I mean, if you can see that on the daily, it's very likely on the 4 hour and the 1 hour, that's very clear for an entry. And then we're looking for this structure: impulse, correction, impulse, correction, and then a push down, which is likely a bit of volatility of news, which again, volatility is not direct in the market. News just creates volatility, not direction. As you can see, we're just pushing lower and lower and lower. And again, it just goes to show you with the overall structures, when you can understand them and you've got good management in place, you know when to evolve with the market, you're going to have a much better picture as to what's going to happen next. So let's just take that price back. And as you can see, we fill pretty much 90% of it with that wick there, and then we go on to create a much deeper structure. But overall, you can see why, if you only took the trend line as the trend line, as right, this is a trend line, oh, we've broken, and you constantly evolve, you have to wait for some confirmation. So the best way to evolve is, rather than constantly evolving your trend line, which is not what we do, we don't just evolve like this, we wait for confirmation. You don't know when to evolve the structure until something is confirmed. So the next time you see something like a bit of price, if we just take that to here, we know structurally what we're looking for, because we've got the move up, then we're looking for a correction. And the truth is, guys and girls, if you're new to Falcon, new to trading this way, we're actually expecting this to happen. So there's a different layer to this, which you'll learn from the weekly content and the mentoring as well. And this is not a matter of we're putting a trend line in, waiting to see, is it corrective or is it impulsive? We're looking on a much higher degree, utilizing multi-time frame analysis, which you've learned, that this breakout could be testing all the way to these highs as well. So we'd already be looking and essentially expecting a larger correction for this to move to the upside. So that's another layer of it as well. And that is the beauty of understanding the true art of pattern identification. But when you can evolve with the structure, it's absolute game changer for you. So what I would do is I would go and backtest this on multiple pairs, so you can see on the high degree, on the daily, weekly, 4 hour, 1 hour, and see these patterns, how they evolve, and look at the most recent 2 touches. That will give you the most accurate form of data and accuracy to be able to then enter the trade. So I hope that helps. Go and check that out with the evolving. Now we're going to get into the next stage of the strategy.
Created with free version for non-commercial use.